More and more UK investors now have to include crypto in their self-assessment tax returns. HMRC is tightening its focus on UK crypto tax, with a new crypto section on the capital gains pages and growing use of data from exchanges to check returns. If you are unsure where to start, this step-by-step guide will help you prepare your data, calculate your figures, and file your return correctly. You may need to complete self-assessment for UK crypto tax if your total gains from crypto and other assets exceed the £3,000 capital gains tax allowance in 2025 and 2026, or if your total disposal proceeds are large, for example, from selling big positions, even if the net gain is small. Also, if you receive crypto income like staking, mining, airdrops, salary, or freelancing that is not taxed via pay. If HMRC has sent you a tax return notice or information request, or if you have previously underreported or not reported crypto and want to make a voluntary disclosure, you should definitely take action. If in doubt, honestly, it is safer to declare than ignore your crypto. Accurate UK crypto tax reporting starts with complete and clean data. So, collect CSV exports or tax reports from every centralized exchange you have used. Make sure you gather wallet transaction histories for on-chain activity and records from DeFi platforms, NFT marketplaces, and yield platforms. Don't forget evidence of fiat deposits and withdrawals to and from your bank accounts. Where possible, keep copies of original CSVs and any API-based reports for your records. HMRC can ask for evidence going back several years, so it's important to be thorough. Because manual spreadsheets can be error-prone, most investors now use a crypto tax tool to consolidate data across exchanges and wallets before sending it to their accountant. For UK crypto tax purposes, you should group your transactions into three main categories. First, acquisitions. That's where you acquire tokens like purchases, some airdrops, or gifts from others. Second, disposals, where you sell, swap, spend, or gift tokens. Third, income events, which include staking rewards, mining, referral bonuses, or salary and fees paid in crypto. Transfers between your own wallets and exchanges usually are not disposals, but they must be matched correctly to avoid double counting. It's a bit of work, but getting this right makes all the difference. Okay, so, UK capital gains tax uses something called share matching rules. There are three main ones to keep in mind. First, the same-day rule. Second, the 30-day or bed and breakfast rule. And third, the Section 104 pooled holding. And just so you know, these rules apply to crypto in the same way they do to shares and other assets. For each disposal, you'll need to calculate the allowable cost, which comes from either the Section 104 pool or the matching rules, the proceeds in pounds sterling, and, of course, the gain or loss. At the end of the tax year, you'll want to add up all your gains, add up all your losses, offset your losses against your gains, deduct the £3,000 annual capital gains tax allowance, and then apply the correct capital gains tax rate, which is 18% or 24% for most non-residential gains. Oh, and if you have any unused losses, you can carry them forward indefinitely, as long as you report them to HMRC. Right, next step is to calculate your crypto income for the year. For each reward you receive, make sure you record the value in pounds sterling at the time you got it. Then, group your income by type, like staking, mining, airdrops, salary, and so on. Don't forget you can deduct any allowable expenses, such as a portion of your electricity costs for some mining activities, if that's relevant. All these totals are then included in the income section of your self-assessment return, and taxed at your marginal income tax rate. For the 2024 to 2025 tax year onwards, self-assessment actually includes a dedicated crypto area within the capital gains pages. You will typically need to enter your total disposal proceeds for crypto, your total allowable costs, your net gains and losses, any losses brought forward and used, and, well, any additional information needed to explain complex situations. Where you are making a negligible value claim, or correcting past years, supporting notes, are really essential. Because UK crypto tax rules can be, a bit nuanced, many taxpayers choose to have a specialist prepare or review their return before submission. HMRC can ask to see your calculations and supporting documents years after the event, so make sure to keep your exchange and wallet CSVs, your bank statements, working papers or crypto tax software reports, and copies of filed tax returns and computation summaries. Good documentation just makes any future HMRC question or inquiry so much less stressful. If this feels overwhelming, you are definitely not alone. Many investors now actually prefer to work with a specialist UK crypto tax accountant rather than trying to navigate HMRC rules all by themselves. mycryptotax can reconcile your data across exchanges, wallets, and DeFi. Compute UK crypto tax figures in line with HMRC rules. Prepare and file your self-assessment return. Deal with HMRC on your behalf where needed, and even provide ongoing planning for future years. So, if you're interested, you can book your free UK crypto tax review at www.mycryptotax.co.uk/cryptotax-review, or just give a call on 0203 302 1919. Visit the website at www.mycryptotax.co.uk or email info@mycryptotax.co.uk.